And welcome back, everyone. Week 2, day 8 of the boot camp. Feels crazy to say, but we have already made it to week 2. So if you've been showing up every single day, if you've been putting in the work, if you've really been taking these lessons in, hats off to you guys. Go ahead and give yourself a pat on the back. You should be very proud of yourself because you'd be surprised how many people in the modern world cannot stick to something for more than like 3 days. I'd be surprised if most people stayed with this for even half a lesson, let alone 7 days in a row. So if you made it this far, congratulations. I do not take that lightly, and keep up the consistency and everything else is going to take care of itself. Now, we have a very, very important lesson today. I'm going to be literally covering like everything around liquidity, or as much as we can fit in to this little like 20 to 30 minute window. So we have a lot to get into, but we're going to go ahead and start out by explaining exactly what liquidity is. So if you remember from the last price action lesson, swing highs and swing lows. What is below swing lows, above swing highs? Well, buy stops and sell stops. And what are buy stops and sell stops? Liquidity. So how do we put a definition to this term? What exactly is liquidity? Well, liquidity is the degree to which a market or an asset can be quickly bought or sold without affecting the asset's price. So the stock market, right? You buy and you sell. When you take a buy, does the market just automatically shoot up just because you bought? No. The market also doesn't shoot down just because one person sold. So liquidity is the ease of getting in and out of a transaction without having the price move. Basically, can you get in and out of your position, right? We've seen these freaking meme coin pumps where people are floating a profit of like a couple $1 million, but by the time they exit that position, it only equates to like $500,000. Why is that? Because there's not good liquidity. It's not a very liquid asset, so they're getting filled at these insanely shitty prices. So that is liquidity, put simply. Now, there are a lot of different types of liquidity. The main thing we have to understand as a core concept is liquidity resides above old highs where buy stops are, and that is buy side liquidity, and below old lows where sell stops are. And of course, that is sell side liquidity. So buy side liquidity, sell side liquidity. You see there's a high up here. There is a low right here. And the market has a tendency to run out old highs and old lows. And a key concept within smart money is where other traders look for candle patterns and lagging indicators, RSI, all of this bullshit. SMC traders focus on where existing orders reside. And we're asking ourselves the question, where is the liquidity? If you can't spot the liquidity, if you cannot identify the liquidity, then newsflash, you are the liquidity and you're going to get stopped out. So we don't want that. So let's go ahead and dive into what kind of liquidity should we mark out. Obviously, when you take a look at a stock chart, there are endless levels of highs and lows. Depending on what time frame you are, there's also highs and lows specific to time frames. So how do we avoid a situation where we're marking every single high and low in sight to where it just becomes confusing? Because that's what I used to do. I used to just think, oh, all we need is a liquidity sweep. Well, there's 20 highs within this 10-point range of stop. So I'll just mark every single one of them so I don't miss one, right? That's the best thing to do. I don't want to miss a trade. Why don't I just mark out every level? Wrong. Incorrect. There are certain levels because of aspects of time and price. Remember time and price, we went over this earlier. Because of time and price, certain levels of liquidity that happen at certain times are more relevant to specific sessions. So how do we get this? Time-based liquidity. What is time-based liquidity? Well, it is simply the highest high and the lowest low made between a certain session window. So if we're marking out Asia high and low, that is between 8 p.m. and 10 p.m. Eastern, the highest high and the lowest low made within that window of time. If we're marking out London session high and low, that is 2 a.m. to 5 a.m., the highest high and the lowest low within that window of time. And then lastly, the PM high and low is between 12 p.m. and 1:30 p.m. Eastern, and that is the New York session PM high and low. Some people who trade FOMC and 2022 model during the PM profiles, you'll refer to PM high and low. If you're trading the New York AM session, you'll be referring to London high and low. And many of you seen this explained in some of my short form content. And then lastly, if you're trading London, you're going to lose London high and low for your session. And as we know, I only trade New York AM, so that's the one we're going to focus on for this lesson. But before we get into the rest of these liquidity concepts, let's go ahead and jump on the charts. I'm going to mark out London high, London low for you, and then I'm going to show you exactly how it pertains to the New York session. So I got the price chart pulled up. Now what I'm going to do is I'm going to go ahead and mark 6 p.m. of a candle open. So that is when the day actually opens, is 6 p.m. So we'll put one marker there, and then we'll go ahead. I'm going to make these a little bit thicker so you guys can see them. And then we're also going to put one at the very end of the day when price closes for the day. So that would be all the way over here when the new day candle opens, and this is the close. So this right here is a complete window of a day. So between the time the new daily candle opens to closes, this is the price relative to the 15-minute. This is exactly what happened. Now, what we're going to do is we're going to mark out these sessions. So Asia high and Asia low. What is that? 8 p.m. is where Asia starts. I'm going to pick a slightly different color for this, maybe a green. You can still see that. Boom. So 8 p.m. is right there, and it goes all the way till 10 p.m. So that is our window of Asia session. Now, copy and paste this line. We'll go from London 2 a.m. to 5 a.m. Eastern, and that is going to be the range in which we pick our London high and London low. And then lastly, we have NYSE open, and that is when we trade. So that is right here, NYSE open. And then we also have the PM. So that is between 12 p.m. right there. And then we also have the PM. So that is between 12 p.m. right there and 1:30 p.m., which is right there. So now let's go through and mark the actual high and lows. So we'll go over here and we'll mark the high between 8 and 10 was right there. So that's Asia high. We're going to go ahead and label that AH. I'm going to change the color here. And we'll change the line to a thinner line as well. So there, that is our Asia high. You can see this day, the Asia session was pretty small range. So this range was pretty consolidated throughout Asia, but we ultimately ended up using that consolidation to go higher temporarily. And then we have Asia low. Boom. And you can see that right there. And then this one gets taken, this one gets left intact until into New York session. Now, let's do the same thing, but let's do it for London session. So we'll go ahead and mark the highest high up here from London. And that'll be our London high. And then we'll mark the lowest low from London. And that'll be our London low. So, as we can see, we have Asia high, Asia low marked out. We have London high, London low marked out. Now, how do we actually use this information? So what is exactly the relevance of this in the first place? Like, why would you even want to mark this out? Well, if we go ahead and rewind here, because we're mainly focused on NYSE open, this is when we start trading. We use this for context. We use this for narrative. We use this to give us a hint at whether or not we're going to get a New York continuation. So in other words, we continue the trend from London, or a New York reversal where we reverse on the trend from London. So on this day, contextually, I can already see that London had most likely made the high of the day, right? We opened up, we had Asia session, we just spooled higher, took Asia high, came up, made the London high, and then we had a market structure shift right here. So we had a bearish shift, left a fair value gap, continued from it, rebounded off that order block, continued, left another fair value gap, continued, and we left another fair value gap. So we have not covered fair value gaps yet. That'll be a future lesson. But just so you see kind of how you start to tell a story with price, I can be like, okay, well, it's pretty obvious that London low is not going to get intact because we already took London low. Asia high is looking like a decent low-hanging fruit in terms of a target we can aim for, and we're already pricing bearish off a bearish market structure. If we're aiming for continuation profile through New York, I want to see it enter a point of interest and then leave London high intact, go down to hunt lower liquidity levels and continue the trend. And what happens here? We can see, boom, it does just that. So this is an example of when New York gives a New York continuation. Now, I probably would have wanted a bit more of a discount level up here, but nonetheless, still delivered beautifully. Now, let's go ahead and go through one more example of this, but you're starting to see how we use this for context. And then the PM high and low, you can see, we'll just mark that out just for those of you that might be trading PM session. And the way you'd use that is in a similar way. So between 12 and 1, of course, this doesn't always happen exactly, but you can see even here, we left PM low down here, PM high already got taken. So what's most likely to happen? Retracement, boom, and then we're sending higher prices. Now, let's go ahead and rewind a little bit to the day before that. And we can go ahead and mark these out again to see what price is saying. So between this time right here, this is the new candle open. So we're going to go ahead and make that a little bit thicker here. And then I'm going to go ahead and mark the end of the day as well, which is right here. And then, of course, we got NYSE open. That's located right there at 9:30. And now we're going to mark our Asia session window. So there's 8. And then there's 10. Mark London session. So there's 2 a.m. to 5 a.m. Boom. So let's go ahead and mark those out right now. So we're going to take this line from 8 p.m. to 10 p.m. And you can see here that between that time window, we actually made a low right here. So that is our Asia low. And then we also made a high up here. And that will serve as our Asia high. And you can see in this example as well, Asia high has already been taken. Asia low is left intact, except we have a very important distinction from this day, and we'll mark out London to cover that distinction. So London low ends up being up here. London high ends up being up here, sorry. And then London low is going to be below that. So London low ended up being right here this day. We left relative equal lows down here as well. We'll talk about relative equal lows here in just a second, but this will actually serve as our example for relative equal lows as well. But in this context, this one is a little bit of an interesting one because we still end up continuing, except London low still gets swept. But we do not full on disrespect and reverse and pummel through London low like in a classic reversal profile. We actually end up sweeping London low, and there's also some PD arrays down here that we end up using to price up. And we actually leave Asia low intact. So in this case, Asia session made the low of the day. So sometimes that'll happen when Asia ends up making the low of the day. In that case, as long as the trend continues, you are good to go, because it still ended up being a New York continuation profile. It just reached for a deeper discount relative to where price was at. So beautiful context, guys. This all just, helps you read what's going to happen in the session and just gives you that much more of a probability when you're trying to predict whether it's going to be continuation, reversal, etc., etc. Obviously, some days it's far more clear than others. So as a trader, part of discipline, part of not getting FOMO is being able to recognize and embrace and accept when it's not very clear and simply walk away instead of trying to sit there and fight it. And, oh, if I just draw the line this way, it makes sense. Or if I look at it upside down on my monitor, maybe it's going to make sense. No, guys. When it's clear, it's clear. When it's not, it's not. And when it's not, you walk away. So beautiful examples on this charts. Now back to the slides. Now back to the slideshow. All right, so we covered Asia high, Asia low, London high, London low, PM high. And now you know how to use it within the context of what I taught you in the last price action lesson. Now let's cover a little bit more of an advanced concept, which is the open high, low and close. And this has to do with the higher time frame, but you can also use this for the intraday as well. So open high, low, close, we remember on the candlesticks that we have an open high and low close. If we hop to the daily chart, we can find an example of this. So let's get this stuff out of the way here, and let's mark out the open high, low, close of this daily candle. So you can see the high is up here. So we're going to mark that as the high. And all I'm using for this, guys, is a vertical line on TradingView. And if you double click it, you can just put some text on there. So high is up there, low is down there. And then we also have the open and close. So on a bullish candle, the open is lower than the close. But in this case, we have a bullish kind of doji candle. So it's a very small range between the open and the close. But nonetheless, it still has all four levels: open, high, low, and close. Power of 3. Just to refresh on that lesson, where do we want to be buying on an open, high, low, close if we're looking to go bearish? And in this case, price is looking very bearish going into these lows down here. So I'm thinking we're going to reach down. So if I'm bearish, do I want to be buying down here? I mean, selling down here? Or do I want to be selling above the close price or above the high here? I want to be buying above this level so I can go ahead and get the best, most efficient entry. So the fact that we're selling up here means we have to wait for price to sweep that. We also have a fair value gap there. So let's see what happens. And boom, you can see eventually we hit the low, but we start by sweeping the high. So open, high, low, close, that is how you start to position yourselves for these bigger runs. And if we drop down to the 15-minute time frame, you can also line yourself up with this as well. So price runs into that high during 4 a.m. during London session. So in this case, what would London leave? London would be leaving the high of the day. 5 a.m. is right there. Boom. That up there is London high. And then down here, what do we have? We have London low, which had already been taken. So if we know going into NYSE open right here that we left bearish structure and we also swept daily high and we also want to be buying above that closing price, what does it offer us here? Well, we have London high getting left intact. We have a retracement to a bearish fair value gap that's within a premium level. And we have a reach above the close price. It's not nearly as good as maybe an entry up here, but for your session that day, that's plenty enough for you to go ahead and get in a short and ride that sucker to Valhalla. So beautiful little trade right there. You can see ultimately it reaches even further than that, but you guys are starting to see how you're using the higher time frame levels along with time-based levels. We're really putting together the pieces of a story here. And no matter what day you arrive on, if you follow this exact process, you're either going to get a clear story or a not clear story. And if you have a clear story, you can trade. If you don't have a clear story, then you walk away until it becomes a clear story. But that is open, high, low, and close, power of 3. So you got in on what? A manipulation. And then it what? Expanded, retraced, expanded for the rest of the day. So all of these concepts should start clicking right now. You should be being like, oh my gosh, like that's how that works with that. That's why you mark that. And if you're in that place right now, then it's working. We're getting through. So what else do we have? We have internal versus external liquidity that is within the range versus outside of the range. And we'll hop on the charts to mark that as well. And we also have relative equal highs and lows, which is what I just showed you when those lows were stacked. And honestly, guys, that's one of the best liquidity sweeps ever. If you have 2 or 3 lows that are stacked around or at the exact same level, that is going to be a very, very sensitive level. So real quickly, I'll show you internal versus external range liquidity. And then after that, we're going to go ahead and get to our last examples. So if we take this price range right here, you can see, guys, that we have all sorts of liquidity on the inside of this range. So obviously the highest high is up here and the lowest low is down there. So that is our external liquidity on the outside, on the externals. And that is usually where you get the cleanest sweeps. And it's also where price likes to ultimately target. But sometimes price doesn't like to reach for external. So you have to rely on internal range liquidity. And what is internal liquidity? Well, it's all this stuff in between. So you see right there, that was some liquidity. You can see right here, this is internal range liquidity right here. All this liquidity up here is internal range liquidity. We actually swept some internal liquidity there before we made that move down. And then, of course, we have internal liquidity all throughout here as well. Like all of this is internal liquidity. Obviously, the higher probability is going to be on external liquidity, but just so you know the distinction, guys. And in a ranging market, a classic way to identify a ranging market is when price refuses to touch external liquidity. So you're seeing in between that high and in between that low, no matter how many passes through we get, we are still refusing to touch this high or this low. So in that case, you want to just sit and wait for it to take either side. So that is liquidity, guys. And before we leave, we're going to cover one last concept, which is a little bit more advanced, but I'm going to introduce it in its beginning form. So this is high resistance liquidity. So how do you know when price has good conditions that are good probability versus low probability? Well, this is one of the ways to tell. High resistance liquidity. So this is when price has to travel through several crowded levels of resistance, old highs, and imbalances before it can reach your target. So in other words, it's when the path to the target of your trade is basically just very defended. You want to think of it as like a football field. If you're running down the football field and you have 20 plus defenders ganging up ready to tackle you, you're going to have a very choppy and sloppy run all the way to that end zone. Just like in trading, the more crowded your levels are with opposing liquidity, opposing PD arrays, the harder of a time and the choppier it's going to deliver to that final target. So whenever you see this, like if you got in a buy down here, you got fair value gaps on the bearish side, you got tons of highs, tons of opposing PD arrays, is going to be very high resistance traveling through. And this is where you see your setup play out very slow, very choppy, and you probably question whether or not it's actually going to get there. And same thing with the sell. If you're selling and you notice a whole bunch of stacked bullish levels that are preventing you from getting to your final level. So whenever you see this on the charts, you're going to want to avoid that. And we're going to go much deeper into the different PD arrays as far as what this exactly looks like with high resistance, low resistance. But until we really learn all the order blocks, fair value gaps, all the PD arrays, it's going to be kind of hard to give you guys an example of this. So this is really just an introduction to the base of this concept. And on the other hand, we have low resistance liquidity. So these are high probability conditions. So low resistance liquidity is when price has a clear, unobstructed path to your target with no opposing levels until your initial TP is reached. And this is known as your range of opportunity. So you see on the previous example, how between here and here, we had 4 or 5 plus levels. On this example, in between here and here, we have 0 levels, and we don't have one until here. So at the point where it reaches this very line, this order block, it becomes high resistance. All the way up until here, it is low resistance. That is your range of opportunity. So when we get to entries, you'll learn that one of the entry criterias is you must have that clear, unobstructed path. Otherwise, it is not a valid trade. Now, of course, there is nuance to this as well, due to higher time frame narrative, things of that nature, but we won't dive too deep into that yet. And the same thing with bearish. You want to see a clear range of opportunity before you run into any bullish levels. So that is plenty for you guys to go ahead and get on these charts and get started. Mark out some of these examples of Asia high, Asia low, London high, London low, and then go in that New York session and see if you can start to tell a story with price and what it's showing you. get some examples of internal, external range liquidity, get some examples of open, high, low, and close, marking those on your charts. Really get your hands dirty with this, guys. Study, sift through the charts, and see if this starts to make sense. And also, I want to congratulate you all for making it this far. Comment day 8 complete if you made it through this full lesson, and also comment what was your biggest takeaway from this exact lesson, because at the end of the week, I'm going to do a random drawing and the winner is going to get a free $100 that you can use to go out and fund your next challenge or simply just spend it on whatever the fuck you want. So stay tuned for that. Continue commenting throughout this week because there will be a random winner selected at the end of this next 7 days. So congratulations on making it this far. The boot camp motherfucking continues, and I'll see y'all in the next lesson. Let's fucking go.